Hello everybody, in this video I'm going to talk about GDP. Make sure that you look at the lecture notes and please pay attention to the definition of GDP. That's a very important definition. I want to talk to you about some of the important components of GDP and two different ways of calculating GDP. GDP stands for Gross Domestic Product, as you can see from the lecture notes, and it's a very strong economic indicator in terms of measuring the standard of living, measuring the value of total output, total production of a country, in terms of calculating the total income of a country, how much money people of a country basically can make, as well as how much people of the country are spending money. The bigger the GDP is, it shows that the richer the country is basically. So it has its own weaknesses, GDP, in terms of calculation and even how we define GDP, but still it's a pretty strong economic indicator. And countries actually use GDP to measure the standard of living as well as the economic growth. So our GDP has important components, as I mentioned. The first one is C, which is the biggest component of GDP. And remember that in this chapter, we're just talking about the GDP in the United States, okay? It's just for our country. So one big component of GDP is C, consumption expenditures. It's how much basically individuals and households spend in the economy. The other one is investment, or I, investment. It's basically the amount of new capital that the country purchases to produce more goods and services. The other one is how much the government basically is spending, government spending. It can be the money that government spends on buying, let's say, insurance for its employee, guns, I don't know, how much the government spends on education for its employee, laptop, desk, anything that the government basically purchases, okay? Any goods and services that the government purchases. That will be part of our G. And then we have net export, which is export, the value of our export minus the value of our import. We call it net export or NX. EX stands for export and IM stands for import. Export is what we buy as a country, what we sell as a country to other countries, okay? And import is what we buy as a country from other countries, okay? So the value of how much we sell minus the value of how much we buy from other countries will give us the net export, okay? For United States, it's been a while that we have a negative net export, which means that we are importing more than what we export. So these are the important components of GDP. Make sure you remember them. Now, there are two different ways that we can calculate GDP. The first one, or the first approach of calculating GDP is through the expenditure approach, which is probably the most common way of calculating GDP. It's C plus I plus G plus this net export. So if you add all these components, you can get your GDP, and it's called expenditure approach because it's basically coming from how much the individuals spend, how much the government spends, how much the investors spend, and how much goods and services we sell and buy from other countries. That's pretty straightforward. Memorize this formula, C plus I plus G plus net export. That's one way of calculating GDP. We also have another approach which might not be as straightforward as the expenditure approach, and it's called income approach. So if you add the income of individuals, government, and businesses, you are not going to get GDP. You have to make some adjustments to make the that calculation basically equal to GDP, okay? So I'm going to start with adding up all these different types of income we have, and then I will explain the steps that you should take to calculate GDP using this income approach. So if you add the wages that individuals basically get, and which is the biggest component of our income, then you add the rent, you add the profits that basically individuals receive, okay, plus the interests that again individuals receive. Let's say you have a saving account, the interest that you get from your saving account. You have a stocks and bonds. These are the interest, the income that coming from all those investments. So up to here, basically we are talking about the individual's income, okay? And then we have our businesses, our corporations. So I should also add my corporate profit, which could be the dividends that businesses make. It can be their corporate income taxes, undistributed corporate profits. All of them basically are inside this corporate profit. And then we also have government, right? So the government revenue from taxes and production should be also added in here. If you add all these different sources of income here, this is not your GDP, this is your national income. As somebody who is taking a macroeconomics, you definitely should remember the components of national income, and you hear national income over and over again in news. So you have to know the national income, okay? So national income is nothing but the individual's income plus corporation or businesses income and government tax revenue from production and import. That's your national income. So remember, the national income is not the same as your GDP. It's not equal to your GDP. Why? Because of two things that we have here. First of all, the profit that we have here, right here, the profit we have here is our net profit, okay? Is our net profit. But GDP stands for gross domestic product, right? It is not net, but we have a net profit here. What does it mean, net profit? Net profit is basically gross profit minus depreciation. What is depreciation? Depreciation is the loss in the value of your capital. So let's say you have a printer in your office, you bought it for $100 5 years ago, you're using it every single day. So over time, your printer loses its value, right? So you're not able to sell it at $100 that you purchased 5 years ago. So your net profit is your gross profit minus this depreciation. You are going to replace this printer over time because it's going to lose its value, it's going to stop working. So you have to replace it, right? So your gross profit minus how much you're spending basically on this depreciation will give you the net profit. So what we have here is the net profit. So we have to make this net profit into gross profit, and that's easy. If you add the depreciation, you can have your gross profit, right? So net profit, gross profit minus depreciation. So if you add the depreciation back in here, you can move from net to gross. So that's one reason that that this national income is not equal to our GDP, okay? Also, remember that in all these calculation that we had for our income, for the total income here, we are also should consider the income of foreign companies or foreigners in our economy, in our country. Okay, so we have to, and also we should also consider that some of our American citizen might work abroad. So we have to take out the income that our US citizens are gaining from abroad, and then we should add the income that foreign companies and foreigners are making inside United States. Okay, so if you take out the Americans' income from abroad and then add the income that are gained by foreigners inside United States, you can again take another step and make this national income equal to GDP. Make it basically take one step closer to make the national income GDP into GDP. So we call actually this taking out the Americans' income and adding the foreigners' income net factor income. Okay, net factor income. All right, so we have our national income up to here. Okay, up to here. So now these are the two steps that we should take. So first we calculated our national income. You know the components of national income right now. If you, in the second step, if you subtract this net factor income, and then we had the problem with this net profit. So that was easy. You are going to add depreciation here. Okay, so subtract the net factor income. You typically have the net factor income in the question, so don't worry about how you calculate the net factor income. Just know how we define net factor income. We are taking out the Americans' income abroad and we are adding the foreigners' income. Okay, you have the net factor income all the time, and then you are adding the depreciation. So if you take these two steps, then you have your GDP from income approach. But sometimes the GDP in income approach is not going to be the same as the GDP from expenditure approach. Typically, our GDP from expenditure approach is bigger than the GDP from income approach. But economists basically want to have consistent result from both approaches. In order to do that, we're going to do a little bit of cheating here. They try to calculate the difference between the GDP from expenditure approach and GDP from income approach. The number that they come up with is called a statistical discrepancy. Okay? They are going, the only reason that they calculate again a statistical discrepancy is because they want to have same answer from income approach and from expenditure approach. Okay, so they calculate the difference between GDP from expenditure approach and GDP from income approach. The number between the difference between these two is just one single number, which is called a statistical discrepancy. So in the last step, basically, we are going to add, if we have any statistical discrepancy, if we have any positive number basically, or any difference between income approach and expenditure approach, the economists are going to add this discrepancy, this statistical discrepancy, which is just one single number, to income approach. Then we can have the same result from income approach and expenditure approach. If the question is talking about zero statistical discrepancy, so you are done here. When you add your depreciation, when you subtract your net factor income, you are done, you have your GDP. But if there's a positive number for statistical discrepancy, make sure you add it to your income approach, because we want to have consistent results from these two approaches. That's it. Hope you find this video helpful.